In the acceleration phase, you will see, as the name implies, larger movements rapidly. And obviously, the market's going up, doubling in a year is something you haven't seen in silver until the final phase of the earlier bull market that went from basically 1970 to 1980 in gold. And I would argue from 1966 or 65 to 1980 in silver because silver was basically demonetized out of circulation. So the final phase is when you get the panic manic phase at the very top. We're not there yet. We need to see the public come back into this. But when they do, it'll be unfortunately from history. It'll be more on fear than greed.
Silver is entering a phase of the market that only appears once every few decades, and David Morgan says we are already in it. He calls it the acceleration phase, the period when monetary metals stop behaving like ordinary commodities and begin moving in sudden, powerful vertical bursts. In past cycles, this is the stage where silver didn't just climb, it doubled within a single year. These aren't vague historical anecdotes, they're technical fingerprints from the 1970 to 1980 bull market, a cycle Morgan has studied for more than 40 years. And he believes the setup we're seeing now is stronger, more compressed, and far more global than anything that came before it. But Morgan is very clear about one thing: we have not hit the manic top. The public is not in this market yet. Institutional buyers, national stockpiles, sovereign wealth funds, and industrial producers are accumulating physical silver, but retail is asleep. And that, he argues, is exactly why this moment still represents the beginning of the final phase, not the end. In every historical precious metals mania, the public arrives last, driven not by excitement but by fear. Fear of currency devaluation, fear of retirement shortfalls, fear that their savings are evaporating faster than they can protect them. What makes Morgan's analysis so compelling is that silver today is no longer just a monetary metal. It is now a critical mineral for the United States, essential for military applications, energy systems, advanced electronics, AI chips, and modern infrastructure. Industrial demand has doubled over the last 25 years, while global mine supply is barely keeping pace. When industrial users and monetary buyers chase the same ounces at the same time, silver's price doesn't just rise, it whipsaws upward, violently and unpredictably, because the market is so small and thinly traded. In this video, we break down David Morgan's most urgent warnings, from the misunderstood structure of the silver market, to the skyrocketing demand for 1,000-ounce commercial bars, to the arbitrage opportunities now flashing red across global exchanges. And most importantly, we analyze why Morgan believes the next surge in silver will be triggered not by fundamentals, not by charts, but by a psychological breaking point. When a small minority of the American public suddenly decides the dollar won't protect them anymore. To understand why Morgan is sounding the alarm now, and why silver is behaving unlike any period in modern history, we need to start with a myth most investors still believe about the silver market. Before we dive in, make sure to like, subscribe, and turn on notifications. It helps this channel reach more people who are trying to make sense of these unprecedented market conditions. Thank you.
Well, first of all, I think the public thinks that the silver market is basically the retail market. So they buy silver at their local dealer or through the web. Well-known notables like Miles Franklin as an example, and there's several. And that is definitely part of the silver market. But the real silver market is a derivatives market like all commodities. So it's basically a huge amount of paper contracts that go ebb and flow, up and down, with a lot of professionals that are very good at, let's say, capturing small movements and making large money because it's so leveraged. And I don't think people really understand that part of the market or how it actually operates. And then on top of that, the real silver market not only being run by derivatives, but the fact that 1,000-ounce commercial bars are the true silver market. In other words, that's the price that's discovered by the contracts sold on the futures exchange. It's there in London, it's in New York, and of course there's the Shanghai Gold Exchange that does something similar. There are other smaller markets. And so I think the misunderstanding can be that what drives the silver market is perhaps the retail investor buying silver. Certainly that has an effect. but the real effect is the commercial bar market. And we're in a position now that is what's new is that demand for commercial bars exceeds the supply. Is it momentarily or is it from now on? I do not know. What I do know is momentarily, meaning the past few months, there's been a mismatch between the amount of physical silver available at the right location at the right time. And this has produced discrepancies in price discovery, meaning that there's an arbitrage opportunity. Arbitrage means it's a given commodity or stock or house or whatever that's identical or fungible, and it has a different price in a different area. And so you take the product to the new area and get a higher price for it. That's an arbitrage. And that's been happening in silver a few times here lately, which is rare to take place, especially this often. And we're seeing that reconciled, perhaps momentarily, with what's taken place here recently. I think the bottom line to summarize it, Michelle, would be the demand for industrial silver, the 1,000 ounce bars, is at a level that I have never seen before. And it's causing, in my view, or one of the main causes, to see a significant rise in the silver price.
What is the data that corroborates that it isn't there?
One is the arbitrage I just mentioned. That's a data point that you can point to as a fact. The other one is less notable, but certainly there as a fact. That is that silver became a critical mineral recently for the United States. Critical really means strategic, and it was used basically for something that you have to have, especially in a strategic sense, meaning militarily. The strategic stockpile before it was turned into silver eagles and sent out to the U.S. Treasury to mint was 139 million ounces. So if we go back to that kind of a level over the next few years, that's a further demand on the silver pile that exists that's shrinking year over year. So that's one. The other one is India has become much more into the silver market. They always have been, but of late they have been very, very large purchases of silver. In fact, they have a similar ETF to what we know as the SLV or PSLV, where it's physically backed by silver and they cannot actually get the amount of physical they want at this time to back up new shares of their ETF. That can be pointed to as a fact. Another one is Russia has bought into silver, not necessarily from a monetary perspective, but from a strategic asset perspective. And I would say that would be another one. And you can also look at the Saudis bought about 1 million shares of the SLV recently. And of course, that sounds like a lot for you and I, but for them, I mean, 1 million shares is not very much. But nonetheless, it does show that there is a nation state willing to take a stake in silver. And that is not a first, but it's a first in this bull market. So these factors all are synergistic in a way. And lastly, I would say that the inability to have the silver get to the right place at the right time, that's more of a logistics problem, but yet it seems to be occurring more and more. It's sort of like a shuffling the pea between the shells. Where is it? Who needs it? Where's it going to go? And that's probably a good analogy for where I see the market. All markets move at the margin, as you know, and the margin for silver is at the monetary. But the industrial demand has gone up very, very rapidly. In the last 25 years, which sounds like a lot, but in human terms, but in monetary terms, it's nothing. So if you go back 25 years ago, 35% of the market was industrial demand. And at that time, we only mined 550 million. Today, industrial demand is probably pushing 70%, and we mine 850 million ounces now. So think about that. The amount of demand 25 years ago was 30 of 50, so maybe a couple, 250 million ounces. Now, 70% of 9 is like 600 million. So that doesn't go away. Now, in a big recession or a global contraction, it could mitigate it somewhat, but not that much. Now, the calling card is the monetary demand, and that's where the retail has backed off. I just checked again today with a couple of the big wholesalers, and they're still buying back more silver from retail than they're selling. But bigger institutions, as you outlined, Michelle, are buying silver for monetary purposes. And the industrial demand, I think, is where I've talked about for years, which means when that point in time happens, where industry and monetary demand come together at the same time, we are going to see an explosion in the silver price. And it's basically more industrial right now, I'd say, than monetary, at least from the retail side. But both demands are there and accelerate. And this is something that in a very small market like silver, you could see these extreme moves, which you've seen the last 3 or 4 days, where we go from, oh, it hit 54 and it comes right back down to the 50-day moving average. And then all of a sudden it goes past 54. We're sitting near 60. And that's the silver market.
David Morgan begins by destroying the biggest misconception in the entire sector, the belief that the silver market is dominated by retail buyers. In reality, the true silver market is the derivatives market, where massive, highly leveraged paper contracts move prices long before any coin or bar changes hands. Futures traders in New York, London, and Shanghai set the global spot price, not retail buyers purchasing eagles and maple leafs. What matters even more is that the price is actually discovered by 1,000-ounce commercial bars, the bars consumed by industries, refineries, mints, and institutions. And this is where Morgan drops the bombshell. Commercial bar demand now exceeds available supply, a condition he has never witnessed in his entire career. Physical shortages at specific locations have triggered arbitrage opportunities, meaning identical silver is trading at different prices in different regions because the market can't get metal where it needs to go when it needs to be there. When you combine industrial users scrambling for supply, national stockpiles building reserves, India absorbing enormous amounts of silver, Russia and the Saudis accumulating strategic quantities, and ETFs abroad struggling to secure physical metal, you get a market under extreme structural stress. And that stress is beginning to express itself in price.
We have been in a secular market since basically year 2000 for gold and 2003 for silver. And we've gone from 252 gold to 4,400. It's backed off somewhat. But all markets move basically in 3 phases up, or 5 overall legs. There's an up phase, a down leg, an up phase, a down leg, and a final up leg. We're in the final up leg. I just had one of my clients ask me this very question. I explained to him that in the acceleration phase, you will see, as the name implies, larger movements rapidly. And obviously, the market's going up, doubling in a year is something you haven't seen in silver until the final phase of the earlier bull market that went from basically 1970 to 1980 in gold. And I would argue from 1966 or 65 to 1980 in silver, because silver was basically demonetized out of circulation. So the final phase is when you get the panic manic phase at the very top. We're not there yet. We need to see the public come back into this. But when they do, it'll be, unfortunately, from history, it'll be more on fear than greed. It'll be fear that the dollar's losing value, fear that I don't have enough for retirement, fear that my pension plan won't be there, fear that my IRA is going to be taxed beyond what they originally said. I mean, there's all kinds of things I can make up, some of them legitimate, some maybe out in the weeds. Nonetheless, the point being that fear drives a market harder than any other emotion. And I don't like to see it, but I do know the markets. And I do believe that's what we're going to see within the next couple of years. And many people say, well, the silver deficit that we've talked about will guarantee, well, they haven't used the word guarantee, suggest strongly we have a 10-year bull market. On fundamentals, I agree with them totally. But being a student of the markets since I was a 16-year-old kid, I'm well past that now, we're in the acceleration phase, and it doesn't want to get a big movement in a short amount of time. And this is what we've already had.
What's the catalyst? What's the trigger for that big surge?
It's fear. It's that people think that their currency is going to become worthless. You know, as we debase the currency, it becomes worth less, and it's worth less, and it's worth less. And then there's the fear it's worthless. And when you hit that psychology, the real move in inflation, people base it on, how much money has been created. And that's part of it. I mean, as a strict Austrian, that's the exact definition. But the true meaning is the psychological factor that cannot be overcome. When 1%, 2%, it doesn't take a huge percentage of the population believes that their currency is going to fail and I've got to buy something of value to maintain my purchasing power. When that moves into the US dollar, and it has, but not to a big degree yet, when that takes place, you really can't undo that psychology. And that's when the run to gold really starts. And the old adage, there's no fever like gold fever, is very true. When people run on fear and they think that the only thing that they can do to protect themselves is to own something that doesn't have a counterparty risk, is known to be of value for thousands of years, and something they can believe in and actually assuage some of that fear, you will see a move into the precious metals we've probably never witnessed before, because we now have the internet, instant communication, and easy access over the web to purchase precious metals. That didn't exist in 19.
What scenario could actually be that tipping point that accelerates the fear? That's a likely scenario.
Yeah, there are several. Maybe they aren't all that likely, Michelle, but I'll do my best. I mean, I remember when Barings Bank went, and I don't know how old I was, probably my, and I thought, aha, that's it. Barings Bank, I mean, that bank was around forever. Nope, it caused a little blip. A war breakout or accelerating, like what happened in the Middle East during the Bush administration. Is that a catalyst? No, it causes a small blip. But I think it could be a very minor thing this time, because the market is in this acceleration phase and more or less looking for almost any excuse. So you could have a problem with the money center bank going down. That could cause it. You could have a circuit breaker go out in Chicago that doesn't keep the cooling system alive for 10 hours. And that causes people to scratch their head. So it could be something in this phase of the market where it's actually fairly minor. You could have a cyber attack. You could have an announcement by, let's say, someone in the Middle East or Asia, perhaps, saying, you know what, we actually think silver is such a strategic metal that we too are going to compile silver for a strategic reserve in our system. India is going to do it. Someone else. So there's a lot of factors that may not have packed very much punch in the past. But at this certain juncture that we are now facing, they could have much more meaning than they would have, let's say, in years gone by.
You have said that timeline is approaching faster than we anticipate as well.
Well, most thinking people don't want it. China has been the beta test for a very long time. For all practical purposes, the Chinese have been on a digital-only, cashless society and it worked very, very well. Almost anyone in the cities of China basically use their phone with Tencent or WeChat to make a transaction. And it's all monitored, it's all known, and it works very, very well. So that's basically the system that the globalists want for the new monetary system. And I think that the idea of having a central bank digital currency or a private version of a central bank digital currency is pretty much just around the corner. And in that case, I'm not certain that you'll see it tied to gold, although it could be. My take still is that the initial rollout will be without any tie to anything. In other words, MMT, modern money theory. We know through monetary policy, we could control the value of the money. And there are these digital units, and you get them by universal basic income, or you earn them at work. And you'll see how the system moves forward with that idea. If that idea fails, then I think the banks will quickly mitigate that issue and bring gold into the picture and say, okay, we're going to base it on the tokenization of gold, and the new unit is backed by 40% gold or whatever. And of course, that's going to be extremely hard for people like myself to buy into, because it's just rhetoric from the political class that I don't trust. But nonetheless, I think it would work on the general.
When Morgan zooms out, his message becomes even more serious. He argues that gold entered a secular bull market in 2000, and silver followed in 2003, meaning we have been climbing through a multi-decade structure with 3 major up phases. According to Morgan, we are now in the final up leg, where markets move the fastest, the sharpest, and the most violently. This is where long-term fundamentals compress into short-term explosions. This is where silver historically moves in ways that shock even veteran traders. But the real catalyst for the parabolic move isn't supply deficits, industrial demand, or even central bank buying, although all those forces are active and intensifying. The true trigger, Morgan insists, is fear. Fear that the dollar is losing purchasing power. Fear that retirement savings will not survive inflation. Fear that the tax burden on retirement accounts will increase. fear that the financial system is becoming less stable, not more. Only a small percentage of the population needs to panic for a monetary metal like silver to launch upward with extraordinary speed. This psychological shift is where bull markets become manias. It's when people stop asking, "Should I buy silver?" and start saying, "I need to buy something, anything, that the government can't print." In Morgan's view, the next few years are shaping up exactly like every inflationary turning point in modern history. A slow erosion of confidence, followed by a sudden collapse in belief. Once that moment hits, once the public realizes the currency they rely on is declining faster than expected, the move into hard assets becomes unstoppable. And according to Morgan, we're closer to that moment than most people think. The industrial monetary collision is already underway. Global buyers are already competing for the same bars. Arbitrage gaps are already appearing, and the acceleration phase, where silver can double in a year, has already begun. The question now is not whether silver will move, but how quickly sentiment will shift from complacency to fear. If you found this breakdown valuable, please subscribe, like the video, and share it with someone who watches the markets closely. Drop a comment below telling me whether you think we've entered the acceleration phase or if the real mania is still ahead of us. Your engagement helps this channel reach more people who want clarity in uncertain times.